$300,000 sitting in an S&P 500 index fund, touched by no human hand, becomes approximately $2 million in 20 years at the market's long-run historical average annual return. You don't pick stocks, you don't time the market, you don't hire anyone, you stop. The problem is that stop is one of the hardest instructions a human being can follow when they've spent a decade grinding to reach 300,000. The discomfort of inaction feels like negligence. And that discomfort, that itch to do something, anything, will cost most people somewhere between $150,000 and $250,000 over the next 2 decades. Here's what the title didn't say. The journey from 300,000 to 2 million isn't about finding better investments. It's about understanding why 300,000 is the specific, mathematically unique threshold, where the rules of wealth building undergo a complete phase shift, and then following 5 rules that most people break almost immediately after crossing it. Let me ground this in math before anything else. At 10% annual return, the S&P 500's average annual return since its launch in 1957, with the past 40 years averaging 11.5% according to Fidelity's calculations. A $300,000 portfolio generates $30,000 per year in returns, year 1, without a single additional contribution. Here's why that number matters. For most Americans who save and invest meaningfully, the amount they can realistically contribute to the market in any given year, after taxes, after expenses, after the mortgage. And the kids and the car sit somewhere between $15,000 and $35,000, which means at $300,000, your portfolio is now contributing as much to your wealth as you probably are. The engine has kicked on. Your job, starting now, is not to find a better engine. Your job is to not break the one that's already running. The 5 rules I'm about to show you are not about stock picks or economic cycles. They are about not extinguishing the fire. In nuclear physics, there's a concept called critical mass. It's the minimum quantity of fissile material required to sustain a chain reaction without outside input. Below critical mass, you put energy in, you get a controlled output. Take away the fuel, the reaction stops. At critical mass, something fundamentally changes. The reaction sustains itself. Each split atom releases the neutrons that trigger the next split. The system generates its own fuel. You are no longer driving the reaction. The reaction is driving itself. $300,000 in the market is, for most people, financial critical mass. Below that number, you are the primary force in your own wealth building. Your monthly contributions, your savings, discipline, your hustle, those are what move the needle. A great year for the S&P 500 is nice, but your behavior is the dominant variable. Above 300,000, that relationship inverts. The market is now contributing more to your wealth than most people can contribute from their paycheck. Every additional year, the base grows, the returns on that base grow, and the growth on those returns grows. The reaction sustains itself. There's one operational instruction for everyone who has crossed this threshold. Don't touch the reactor. I'm going to come back to that phrase several times in this video, not as a catchphrase, as a literal description of what the data says works. Before I show you the most underused legal wealth acceleration in the US tax code, and I'll get to that next, you need to understand the single thing most likely silently eating your portfolio right now. Because Rule 2 is the most financially impactful one, and I want you to see the math before we go anywhere else. There was a guy I'll call Marcus. He works in logistics management in Denver. Built $320,000 over 15 years of disciplined saving. Went to a financial advisor, the nice kind, the one with the view and the custom proposal deck, and handed it over. The advisor charged 1% of assets under management per year. Standard, normal, the industry average. Here's what 1% actually costs. Year 1, $300,000 at 1% is $3,000 in fees. The market returns 10%. After fees, Marcus keeps 9%. Fine, barely noticeable. But here's the compounding problem nobody walks you through at the advisor's office. The fee doesn't stay at $3,000. As the portfolio grows, the fee grows with it. At year 5, when the portfolio might be 450,000, that 1% is 4,500 per year. At year 10, closer to 700,000, it's 7,000 per year. Every dollar paid in fees is a dollar that never compounds again. Compounding works in both directions. When your portfolio earns returns, those returns build on themselves. But fees compound in reverse, reducing the base on which your future growth is calculated. Over 30 years, starting at $300,000, a 1% annual fee, with no additional contributions, costs approximately $1,250,000 in lost compounding. I'm not estimating. Here's the exact math. The S&P 500 has averaged about 10% annually since 1957. 300,000 at 10% for 30 years becomes 5,234,000. The same 300,000 at 9% representing the 1% drag becomes 3,980,000. The gap, $1,250,000. Not to the market, not to bad timing. To someone whose primary value proposition is underperforming the thing you could have bought yourself for essentially nothing. And here's the reversal in this section, the one that should land like a brick. You think the problem is finding the right investments, the right manager, the person with the track record and the Bloomberg terminal and the conviction calls. But according to the 2024 SPIVA US scorecard, 94% of US large cap active funds underperformed the S&P 500 over a 20-year period. And among active funds, 38% beat their passive peers in 2025 after accounting for fees, and only 21% of them survived and came out ahead over the 10 years, ending in 2025, according to Morningstar's research analyzing 9,248 funds. 1 in 5, after surviving a decade. That's the best case hit rate for a fund manager charging you more than 10 times what an index fund costs. The average expense ratio for index equity mutual funds is 0.05%, while actively managed equity mutual funds average 0.64%. The premium you pay for active management buys you, statistically, worse performance. Marcus's advisor put him in an actively managed fund, charging 0.8% on top of the 1% advisory fee. That's 1.8% in total annual drag. On $300,000 in year 1 alone, that's $5,400. On what will grow to $500,000 by year 5, it's $9,000. On what will grow to $700,000, it's $12,600 every year for the privilege of underperforming the index he never bought. By the way, hit subscribe if you're getting value from this, otherwise YouTube's algorithm might not surface my videos again, and I publish new research every week. The lesson is not that financial advisors are uniformly bad. Some provide genuine value in tax planning, estate coordination, behavioral coaching. The issue is the 1% AUM fee as a default charging structure when the underlying implementation is a portfolio of index funds. At the end of 2025, passive ETFs had an average expense ratio of 0.135% according to Morningstar, compared to the 1% industry standard advisor fee. You can hire a fee-only fiduciary financial planner for an annual flat fee of $2,000 to $5,000 for genuine planning work, and then handle the actual index fund, investing yourself for 3 basis points. The combined cost is a fraction of a percent. The outcome beats what most managed portfolios deliver. VOO, the Vanguard S&P 500 ETF, has an expense ratio of 0.03%. On $300,000, that's $90 per year. Not $3,000, not $5,400, $90. Kill the fee drag first. It is not the flashiest rule. It is the most mathematically impactful change you can make the week you cross critical mass. Stay with me, because this next section contains the thing that changes the math again, and I've almost never seen it explained in plain English outside a CPA's office. There is a strategy called asset location, not asset allocation. That's what you own. Asset location is where you own it. And after critical mass, when you have money spread across a 401k, a Roth IRA, and a taxable brokerage account, location is a free source of additional annual return. Here's the mechanic. Your traditional 401k or traditional IRA grows tax deferred. You pay taxes when you withdraw in retirement. Your Roth IRA grows completely tax-free. Every dollar of gain inside that account is yours, untouched, forever. Your taxable brokerage account gets taxed as it goes dividends in the year received at ordinary income or qualified rates. Capital gains when you sell. Most people take their allocation 80% equities, 20% bonds, and mirror it identically across all three buckets. This feels logical. It is wrong. The correct structure: put your highest growth assets, total market index funds, S&P 500 index funds inside the Roth IRA, because those assets will generate the largest gains over time. And in the Roth, those gains never get taxed. A stock index fund that grows 10% per year inside a Roth delivers the full 10% to you, compounding for decades, tax-free. The same fund in a taxable account has dividends taxed in the year received and capital gains taxed whenever you rebalance. Put bond funds and REITs assets that generate ordinary income taxed at your marginal rate inside the traditional 401k, where they compound, tax deferred. Keep the most tax-efficient assets, low turnover, total market index funds with minimal distributions in the taxable account. This is not a new investment. It requires no new accounts. It's a reshuffling of what sits where. And Vanguard research has estimated this approach adds between 0.2 and 0.75% to effective annual returns, depending on account, mix, and tax bracket. On $300,000, 0.5% per year in additional effective return, compounded over 20 years, adds approximately $100,000 to your terminal portfolio value. $100,000 from an afternoon of moving assets between buckets. The Reactor produces more fuel without any new material added. Here's where the tax code becomes your active collaborator. In 2026, the IRS increased the 401k contribution limit to $24,500. The IRA contribution limit increased to $7,500. If you're between 60 and 63, you qualify for what's called a super catch-up contribution. You can contribute up to $35,750 to your 401k alone. That's $32,000 of tax advantage space per year per person into which your compounding runs without the government taking a cut along the way. If you're not maxing those accounts before investing a single dollar in a taxable account, you're voluntarily paying extra taxes on compounding returns that the tax code explicitly allows you to shelter. The law wrote you an exemption. You're declining it. Don't touch the Reactor. And make sure the IRS isn't touching it either. Knowing these numbers is genuinely useful, but knowing the numbers and actually building a system around them are two different things, and the gap between them is where most people lose 5 to 10 years of compounding. I built a digital book called The Exit Code. It's 8 chapters of analysis built on 50 years of actual retirement research, not anecdotes, not motivational frameworks, but the data on what happens to real portfolios over real time horizons when specific decisions are made. 2 things in there connect directly to what I've covered so far. The first is what I call the 4% trap. The 4% rule the idea that you can withdraw 4% of your portfolio each year in retirement and essentially never run out has been repeated. So often it has become financial gospel. But the historical failure rate of that rule under specific sequence of return scenarios is substantially higher than its proponents tend to advertise. The book walks through a dynamic withdrawal method that adjusts to market conditions instead of blindly applying a percentage in year 1 of a market decline. The math on why this matters to someone who just built a multi-$100,000 portfolio is not theoretical. The second is the lazy portfolio structure, a specific allocation that across 30-year historical windows has outperformed the vast majority of active traders. Not because it's clever, because it doesn't get in its own way. It's the same logic as the index fund argument applied at the portfolio construction level. You can get it through the link in the description for less than what you'd spend on a dinner out. The math in it compounds. Every year you delay having a clear framework for the withdrawal phase adds risk to a plan that should be running like a self-sustaining reaction. Now here's the part that sounds obvious and is nearly impossible in practice. The single greatest variable determining whether 300,000 becomes 2 million is not the fund you're in. It's whether you stay in the fund when the market loses 20% in a calendar year. 2022. The S&P 500 returned negative 19.44%. That is a number from the last 3 years of your actual life, not a historical abstraction. The S&P 500 delivered an average return of 23% in 2024, following a strong performance of 24% in 2023. Those two numbers represent what was sitting on the other side of 2022's 19-point decline. The people who moved to cash in the fourth quarter of 2022 missed both of those years. Let me show you what that means in actual dollars. Investor A starts 2022 with 300,000, ends it at 242,000 after the 19.44% decline, panics in December, moves to a high-yield savings account at roughly 4.5%. 2 years later, he has approximately 279,000. Investor B, same starting point, same bad year, ends 2022 at 242,000, does nothing, stays in the index, ends 2023 at 300,000, ends 2024 at 369,000. From the same starting point through the same bad year, Investor A sits at 279,000, Investor B is at 369,000. A $90,000 gap created entirely by one decision. And that gap doesn't stay at 90,000. Investor B's 369,000 earns 36,900 at 10% in year 4. Investor A's 279,000 earns 27,900. The $6,000 annual return differential, compounded forward for 15 years, produces a gap at the finish line, measured in hundreds of thousands of dollars. This is where the Marcus and Keith subplot gets real. Marcus moved to cash in October of 2022. He watched his portfolio drop from 320,000 to 258,000 and called it protecting capital. His advisor agreed with the move. 4 years later, Marcus is at $450,000. Keith is Marcus's coworker. Same company, similar income, same starting portfolio in 2022. Keith doesn't have an advisor. Keith has a Vanguard account, a Roth IRA, a target date fund in his 401k, and a singular discipline. He does not touch the Reactor. Keith is at $640,000. 4 years, same market. The only variable is whether the investor interrupted the compounding. Here is the parable that clarifies this mechanically. Imagine you own 40 acres of farmland. You paid $300,000 for it. A drought hits, appraised value drops to $240,000. Does any reasonable farmer sell the land in a panic because an appraiser changed their estimate? Of course not. The soil didn't evaporate. The structural productivity of 40 acres of good land didn't change because someone updated a spreadsheet. The farmer waits for rain, continues working, collects whatever comes in. Your S&P 500 index fund in 2022 was not structurally worse as an asset because the price dropped. The 500 largest American companies did not collectively become worse businesses. Their earnings continued. Their long-run capacity to generate returns was unchanged. But the number on your screen was red. And that red triggered what behavioral economists call loss aversion. Studies consistently show that investors often earn less than the funds they're invested in simply because they try to time the market or let emotions dictate decisions. The pain of a declining portfolio is real. The financial response to that pain is almost always destructive. Looking at rolling 20-year periods since 1928, the S&P 500 has never had a negative real return. 30-year periods are uniformly positive. Not probably. Every recorded instance, including starting dates at the peak of the dot-com bubble, starting dates right before the 2008 financial crisis, starting dates in the middle of the Great Depression. If you hold a low-cost index fund for 20 years, the historical data says you win every single time. The Reactor doesn't need managing. It needs to be left alone. Now here's where all 5 rules converge into a system and where the compounding math gets genuinely surprising. In 2026, if you are under 50, you can put $24,500 into your 401k, $7,500 into your IRA. Add a health savings account if you have a qualifying high deductible health plan, roughly $4,000 of triple tax advantage space. The only account in the US, tax code that gives you a tax deduction on contributions, tax-free growth, and tax-free withdrawals for medical expenses. After 65, it functions like a traditional IRA for any purpose. That's $35,000 per year into accounts where the government cannot touch the compounding gains while they grow. Now here is the acceleration math that changes the picture entirely. Scenario 1, $300,000, no additional contributions, 10% annual return, time to $2 million, approximately 20 years. The reactor running on its existing fuel. Scenario 2, $300,000, $30,000 per year in additional contributions, 10% annual return. Time to $2 million, approximately 15 years. 5 years faster. Not because $30,000 is a massive contribution relative to the $300,000 base, but because every dollar added to a running reactor gets multiplied by the same compounding force that's already working on every dollar that came before it. The first principle's insight here is one most people never stop to calculate. At $300,000 earning 10%, your portfolio's annual return is $30,000 per year. If you then contribute $30,000 per year additionally, you have effectively doubled your investment income without earning a single dollar more at work. You now have $60,000 per year going to work inside the compounding system, 30 from the market, 30 from your savings. That $60,000 earns $6,000 in the following year, which earns $600 the year after that. The reactor doesn't just sustain itself. Your contributions add new fissile material to a chain reaction already in progress. The flip side, and this is the uncomfortable part, is the cost of what doesn't go in. At $300,000 growing at 10%, every $1,000 you spend instead of contribute costs, you approximately $6,728 in terminal 20-year value. That's the rule of 72, applied to a large base. Divide 72 by your annual return to estimate doubling time. At 7%, money doubles roughly every 10.3 years. At 10%, every 7.2 years. $1,000 removed from a $300,000 compounding portfolio doesn't just cost $1,000. It costs a chain reaction of that $1,000 through however many doubling periods remain. This means the day you hit critical mass is the day lifestyle inflation becomes the most expensive thing you can do. The people who hit $300,000 and upgrade the car, the apartment, the subscriptions, spending their excess income on visible proof of their success rather than on feeding the reactor, are cutting the fuel supply at the exact moment the reaction has become self-sustaining. The math doesn't care about the emotional satisfaction of the upgrade, it just runs the numbers. The contribution stack is the fifth rule, and it is not about deprivation. It is about understanding that the compounding multiplier on every dollar at $300,000 is fundamentally different from the multiplier on every dollar at $30,000. The same 30% savings rate at a high performer's income deployed into a running reactor at critical mass produces a qualitatively different outcome than the same savings rate deployed at the beginning of the journey. Let me make this specific with a real scenario. Sarah is 42 years old, project manager at a mid-sized tech company outside Austin, household income of $115,000. She has $300,000 split across a rollover IRA from a previous employer, a current 401k, and a taxable brokerage account. She contributes 6% to her 401k to capture the employer match, roughly $6,900 per year. She has a high deductible health plan, but has never opened an HSA. Her taxable brokerage holds an actively managed large cap fund with an expense ratio of 0.87% and high annual turnover that generates short-term capital gains distributions every December, taxed at ordinary income rates. Her rollover IRA holds a target date fund with bonds in a tax-deferred wrapper, which is actually fine accidental good placement. Scenario A. Sarah continues, as is, effective return after fee, drag and tax friction, approximately 8.6%. Contributions, $6,900 per year. Starting portfolio, $300,000. Time to $2 million, approximately 24 years. Sarah, is 66. Scenario B. Sarah makes 4 changes in a single afternoon. She opens an HSA and starts contributing the maximum. She increases her 401k contribution to the full $24,500 limit, reducing her take-home by roughly $15,000 after the tax benefit of the pre-tax contribution. She moves the actively managed fund in the taxable account to a total market index fund with a 0.03% expense ratio. She opens a Roth IRA, contributes the maximum $7,500 per year, and puts the S&P 500 index fund, their highest growth asset, in the tax-free account. Effective return, 10%. Annual contributions, approximately $32,000. Starting portfolio, $300,000. Time to $2 million, approximately 14 years. Sarah is 56. 10 years faster, $800,000 more in terminal value. Same income, same market, same 300,000 starting point. 4 changes in 1 afternoon. No stock picks, no leverage, no cryptocurrency, no timing, pure system. The actively managed fund in Sarah's taxable account, by the way, was sold to her by a broker who collected a sales commission at the point of purchase. The fund has underperformed the S&P 500 over every trailing period shown on its fact sheet. The fact sheet was included in the original paperwork. Nobody read it. I've described a complete system in about 30 minutes. Max the 401k, Roth IRA, tax location, low-cost index funds. Hold through the correction. The historical response of the retail investor to this information is to spend the next 4 months researching whether there is something more interesting they could be doing instead, and then do nothing. Complexity isn't a strategy. Complexity is anxiety with a color-coded spreadsheet. Let me bring this back to where we started. Marcus is 46 now. Keith is 46. They started at the same point 4 years ago at the same company with similar incomes. Keith has $640,000. Marcus has $450,000. The gap in present value is $190,000. The gap in 20-year terminal value compounded forward at 10% is over $800,000. The entire difference between them is that Keith understood one thing. The reactor was running. His only job was to not touch it. 3 specific things you can do this week, because every year of delayed action compounds against you mathematically. First, calculate your actual all-in cost of investment. Add your advisor fee to your average fund expense ratios. If the total is above 0.25%, find out where the drag is coming from. The cost of 1% of $300,000 compounded at 10% over 30 years is over $1 million in lost terminal value. That is not an abstract number. Calculate your specific number and decide what to do with it. Second, audit your tax location in 1 sitting. Open every account you have and list the assets and account types. Ask 1 question. Is my highest growth asset inside my Roth IRA? If the answer is no, fix it. The move is often a same-day internal transfer with no transaction costs in a retirement account. This is a free $100,000 over 20 years for most people. It requires no new investments and no new accounts. Third, find the gap between what you contributed to tax-advantaged accounts last year and the maximum you could have contributed. In 2026, $24,500 to the 401k, $7,500 to the IRA, roughly $4,000 to an HSA if you qualify. Every dollar of that gap is a dollar that sat in a taxable account, paid unnecessary taxes on its gains, and contributed nothing to a running reactor. Write the gap down. It will tell you exactly how much fuel you've been leaving on the floor. The reactor is running. You built it. It took years and discipline and thousands of small decisions to reach critical mass. The game has changed. The job is no longer to build. The job is to not break it. Lazy investing built more fortune than crypto memes. And if that sounds too boring to be true, the entire actively managed fund industry would very much like you to keep believing